Hello and welcome to your Monday Futures Market Outlook for July 25th, 2011. This is Patrick Serezna. Anyone that has not had the opportunity to try out eMiniSource.com's trading room, 5D complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles that we've gone through. Back in 2009, we bullishly crossed above that 80-week moving average, and the market has remained relatively bullish since. We've been looking for, going into this summer, into the second quarter, a market correction that was could have gone as deep as even the 1200 area on the downside. But overall, the bulls have done a very good job to keep this market correction consolidating more sideways than downwards. So long as all the price action remains above the 1200 level over the next couple of months of consolidation, we should see a bullish resolution to the upside. Just to make some key intermarket observations, the primary trend of the market remains bullish. We were looking for that second quarter market correction, but overall the bulls have done a very good job of containing all the selling. We always say that if the bears have a chance to sell the market, and there's all sorts of negative news, and they don't use that negative news to create the selling, and in fact that in this bigger picture bullish, and that's really what we've seen is a scenario where there's been ample amounts of bearish things going on over the last 2-3 months, and the market really has just been shrugging everything off. In the same regard, the biggest variable going into this third quarter was the US dollar, and we continue to see US dollar weakness going downwards here. So long as the US dollar remains weak, it will lead to there to be natural strength in the commodity markets and weakness in bonds. So it could overall be relatively bullish for the stock market. When we take a closer look at that S&P 500 on the daily charts, we were talking how important it was for the bulls to contain all of the selling to that 1295 to 1305 area. Subsequently last week, the bulls did reverse it right off that support line, and we had an attempt to test the 1355 focal point above. Now there's some overhead resistance up in those levels. Overall, so long as the bulls, let's say, contain everything to around the 1320 area, in terms of any pullbacks, we could still have another proper test of the year highs all the way up into the 1355, 1365, even 1370 areas throughout the week. But we do fully anticipate there to be some significant overhead resistance. So even though we believe that there's room for this market to advance, and we do think it will find it very difficult to do so, as it will more crawl higher than probably shoot higher. Nonetheless, there's nothing bearish yet on these charts. Next here, I want to take a look at the US dollar index futures and drawing on this little flagging formation that's breaking down. Now, one of the big variables that is coming up in the US dollar will be the debt ceiling political circumstances. Right now, obviously, that's weighing negatively on the US dollar. When the debt situation is resolved, it will be very important to see how the US dollar behaves on that news. If whatever circumstances, let's say the US dollar was to break down to 73, and then the whole political situation is resolved, but the US dollar is not able to make any real progress back toward its highs around the 75, 76 area, then that would actually keep the US dollar relatively bearish. And now, one way or another, there probably will be a US dollar bounce at some point as that debt situation is resolved. It will be the degree of the bounce that will actually set the precedence for how the US dollar will behave for the next 2-3 months. Next year, I want to take a look at copper futures, and essentially we continue to find significant overhead resistance just shy of our 455 to 465 overhead resistance level. Really, at this stage, copper is getting a little bit heavy, and there's room for correction if that US dollar, for whatever reason, is given a motivation for some sort of a little bullish pop. We could see some retracing all the way down to even the 420 level back on the downside. Overall, even if there are little consolidations, there's nothing bearish yet here on copper. So we're just identifying that there is overhead resistance and there is room for a little bit of consolidation if that US dollar, for whatever reason, shows short-term strength. Next year, I want to take a look at gold futures, and gold has bullishly broken out, and we've been saying that we've been looking for a little bit of consolidating, and so long as the bulls contain those corrections, that there could be a bullish breakout that goes as high as 1650 and maybe even as high as 1750, depending on how much of a geopolitical motivation will be behind this move. Really, at this stage, we had that break today. And we're seeing a little bit of bullish follow through. At this stage, we still think gold has room to continue to go towards 1650 or more on the upside. But if there is any resolution to the situation in the U.S. and subsequently some stability, that may be a motivation at some point for gold to profit take. But I think that the immediate short-term trend has gold still move higher. Next year, when we take a look at crude oil has been flirting with the $100 a barrel level for a couple of days now. We've seen a little bit of profit taking initially here, but this channel higher in this flag or wedge continues to have room for it to even advance up to the 102, 103, even 105 levels on that focal point up above. While crude oil can strengthen up there, unless they can really show some legitimate bullish breakouts, there is room for crude oil after that move to consolidate downwards back to the mid 90s in creating some sort of a bottoming formation. Overall, I believe that the summer will remain a consolidation in general, and therefore I don't think that things will just outright turn bullish here. It's more going to be an accumulation phase during the summer rather than a breakout. So at some stage, as crude oil advances here, it will find some sort of short-term highs and probably profit take into the middle of August. Finally, I want to take a look at the 30-year Treasury bonds, and essentially Treasury bonds have been struggling along their highs, but surprisingly have not been overly weak. If in order for this to be a double top along the upside in a sort of like a rising wedge pattern, there has to be some sort of a legitimate breakdown move in the 30-year Treasury bond down towards the 122 to 122.5 area. If we have breakdowns down into those zones, then it could feel very heavy and like the Treasury bonds are rolling. But we have yet to see any negative price action yet on the 30-year Treasury. If for whatever reason the Treasury bond has a breakout above to new highs, suddenly we could find ourselves even at the 128, 129 level. So I'm remaining relatively neutral on the 30-year Treasury bond. I want to be bearish, but there is no technical evidence to be bearish yet. How's your Monday futures market outlook? Thank you for joining me.